Hi, and welcome. I'm Rebecca Buck with Life and Health Insurance Advisors, and I'm here today to teach you about annuities and why some people might use annuities for retirement. But first, I would like to tell you a little bit more about myself. I'm someone who is very down to earth. I have a wonderful husband and two beautiful girls who I spend all my free time with. I have owned Life and Health Insurance Advisors for a little over 5 years now, and I truly love what I do. Today, we are going to go through annuities, and I just want you to know that I am someone who would only recommend something that I would recommend to my own family members or even something that I would do myself. And if you have any questions whatsoever, please feel free to call, text, email me. All my information will be found at the end of this video, and I'd be happy to answer any questions you may have. I'm going to keep things simple today, so why don't you follow along and let's dive on in. So today we'll be talking about what is an annuity, the different types of annuities. For example, today we'll be talking about fixed annuities and fixed index annuities. We will compare the two and the different types of money that you could put into an annuity. So first, an annuity is an agreement that you make with an insurance company. You give them money now, and later, oftentimes during retirement, they will pay you a guaranteed sum on a regular schedule, much like a paycheck from your savings. Unlike stocks, annuities earn a fixed interest rate that isn't affected by the market's ups and downs, so your balance won't drop when the market falls. When you are young, you have time on your side. Investing in the stock market makes sense because over the long term, stocks tend to grow more than safe investments. If the market dips, you can ride out the ups and downs and rebuild your account's value before you actually need the money. But by the time you approach the age 59 and a half, however, your priorities shift. You're likely saved a significant nest egg, but you also have less time to recover from big market dips. That's why some people move their money into a safer product, like an annuity. Around this age, an annuity guarantees a set interest rate, so even if the market falls, your annuity balance won't drop. In other words, putting a portion of your money into an annuity at age 59 and a half or sooner or later helps protect the portion of your retirement income that you can't afford to lose, making sure that you don't have all your eggs in one basket. A fixed annuity is simple. You invest money with an insurance company, and in return, they guarantee a fixed interest rate each year. Your balance won't drop if the stock market falls. And that brings us to the benefit of a fixed annuity. You'll have predictable growth. You'll know exactly how much your earnings will be, and it's similar to a bank CD. But an annuity typically offers higher interest rates and grows tax deferred. For example, with a bank CD, you receive a 1099 for the interest every year, but with an annuity, you get a 1099 when you withdraw the funds. So let's look at this case study together. We have Richard, who is 57, and Elaine, who is 59. They have $100,000 in their savings, but they would like for it to grow more than the 1.5% that the bank is offering them. They don't need the money for at least another 5 years, but would like to access it just in case of an emergency. They looked at a 5-year bank CD. So in Minnesota, the average bank CD is about 4%, but is wondering if there are more options. So after listening to Richard's and Elaine's needs, I could offer them, if they were to come in today, the current 5-year effective rate of 5.6% every year. So we could take their $100,000 and grow it into $131,316 over the next 5 years tax deferred. There is a 5 to 10% free withdrawal privilege, penalty free, and this could be different depending on the product chosen. At the end of the 5 years, they could either transfer the money into a new annuity or they could take a lump sum option after the 5 years. They would also get a lump sum benefit with no surrender penalties in the event of a death. Drawbacks of fixed annuity is that you might get lower returns. If the stock market goes up a lot, you may miss out. Or if you needed to withdraw your funds early, there might be early withdrawal fees. Next, let's talk about fixed index annuities. With these, your returns are tied to the stock market index, often the S&P 500. If the market goes up, you'll share some of those gains, but if the market falls, your annuity balance won't drop. You simply earn $0 interest for that period. In other words, you have the upside potential of the stock's rise and protection from those losses when they decline. The benefits of a fixed index annuities are you have a chance for a higher return than fixed annuities when the market does do well. You have downside protection. Your money doesn't go down if the market falls. And tax deferred growth. You pay taxes later when you withdraw. Let's look at the case study for a fixed index annuity. We have Matt and Tracy, a married couple, both age 55. They want to retire at age 66, but are concerned about how much their income is guaranteed. Matt has a Roth IRA of $135,000, a 401k with $395,000, and an IRA with $435,000. Tracy has a Roth IRA of $146,000, a 401k with a $287,000, and an IRA with $468,000. They would like to draw Social Security at age 70 to maximize their benefits, but also have concerns about the ability to rely on revenue stream in retirement. We could work this a few different ways, but here's one solution we could do. With a fixed index annuity with a living benefit rider, we could move Tracy's IRA of $468,000, and when they are 66 years old, the income value grew to $1.186 million guaranteed. This provided them with a guaranteed income stream of $69,533 per year at age 66 for the rest of both of their lives. If one were to pass away, the annuity would still pay the $69,533 to the surviving spouse. They achieve this by only using 25% of their combined assets, allowing the other 75% to still be invested. Drawbacks of a fixed index annuity is there are complex rules like caps and prediction rate sheets that can be confusing. There's limits on gains. You may only get a small percentage of the index gains, and yearly withdrawal fees and optional rider costs may apply. So comparing fixed annuities to fixed index annuities, fixed annuities give you a guaranteed interest rate, simple and safe, but lower growth. Fixed index annuities offer a chance at the market linked growth with limits, more complex, but you don't risk losing money in the market's downturns. Both protect your principal and allow money to grow tax deferred. So who should consider these? For a fixed annuity, it's ideal if you want a simple and guaranteed way to grow money without any risk of losing it. A fixed index annuity is good if you want some chance at the market's gains but still want to protect yourself from the stock falls. It's important. These are long-term products. If you need money soon, consider other options to avoid penalties. What types of money can go into an annuity? Well, almost anything. You can put in non-qualified after-tax money such as cash, savings, CDs, bonds, inheritance or gifts, bonus or windfalls. You can do a Roth IRA. You can do qualified pre-tax money such as an IRA rollover, a 401k or a 403b rollover, a pension, or a 457 plan rollover. So to wrap everything up, annuities can be a useful tool for retirement income. Fixed annuities offer safe and predictable, while fixed index annuities offer some market upsides with protections. Always review all fees, terms, and possible penalties. It's smart to talk with an annuity specialist that you trust before making any decisions. And again, I am Rebecca Buck with Life and Health Insurance Advisors, and I want to thank you for taking the time to watch my annuity video with me today. And if you have any questions, please feel free to call, text, or email me, or set up a time to meet with me at either of my two locations.